To understand the Islamic financial system, here we will look at the main contracts used by the Islamic financial institutions such as Islamic Bank or Takaful in the way how they design their products. Different than their conventional counterparts, Islamic financial institutions are using a lot of Islamic contracts such as debt financing contract and the equity financing contract. Definitely there are other types of contracts used such as ijarah or any other forms of contracts that can be utilized by the Islamic financial institution as long as they are not involving riba. For your information, these two major categories of contracts are up until today becomes the main contract use. We divide the contract into two big categories, these two. The first one we call it as the debt/trade financing contracts. It is called debt financing because contracts such as murabahah and bank bitaman ajil are used to construct or to design financial products such as car loan, housing loan, personal loan, products like that. And those loans become debts to the borrower. That's why these contracts are also referred as debt financing contracts. Sometimes murabahah and bank bitaman ajil are also called the trade financing because murabahah and bank bitaman ajil are trade contracts, sales purchase. That's where they get the name here, debt/trade financing. And then another thing about trade or debt financing contracts, usually you will find the applications of debt or trade financing contracts in the practice of consumer banking. Consumer banking is when individuals go to the bank, in particular they want to get loan or financing from the bank. That's usually the consumer banking. Another type of banking is commercial banking or investment banking or business banking sometimes, and that's more to facilitate business financing. And for business financing, the main contracts used are equity financing such as musyarakah and mudarabah. These are another two contracts. We will then look at in what ways these two big categories of contracts are different. Let's first look at murabahah and bank bitaman ajil. In general, the main difference between murabahah and bank bitaman ajil is in the context of murabahah, the sales purchase transaction are done in cash. It's immediate. You pay, you get the products or the services. That's basically the idea of murabahah contract. On the other hand, for bank bitaman ajil, the payment is done by installment. It takes time to finish up paying for the product or the services the buyer purchased from the seller. That's the main difference. Murabahah cash, bank bitaman ajil involve that because there is installment involved. That's the main difference. Now let's see the application. As I mentioned earlier, debt or trade financing, murabahah and bank bitaman ajil are mainly used for consumer financing such that you want to buy a house. Let's say the price of your dream house is 500,000 ringgit. Assuming that that's the price, so now we have three parties here. The first party is the person who need the loan to buy the house. The second party is the housing developer. And then number three, the financial institution such as the Islamic Bank. First, the client will pay the housing developer the down payment. This down payment is important to indicate that the buyer is serious to buy the house. If the price is 500,000, usually the down payment is about 10%. Therefore, 10% of 100,000 is about 50,000. This 50,000, the client need to get it from somewhere, maybe from his saving, borrowing from his relative, or even borrowing from financial institutions also is commonly done. Assuming that this client has that money, pays the housing developer. This is the first contract between client and the housing developer. The second contract, this is where the client here will sell the house to Bank Islam, assuming that this is Islamic Bank or Bank Islam. How much is the price? Because the client need 450,000, the balance, 500,000 minus 50,000 the down payment. So the client basically needs to find another 450,000. But the client has no money amounting to this value. He needs to borrow that money. So to achieve this objective, basically the client sell the house to the Bank Islam, the second contract here. And this is where murabahah takes place. Now when contract number 2 happens, the client gets the 450,000, the bank gets the house. However, the ultimate purpose of all this contract is for the client to get the 450,000, and the client also want the house. Two things. With the undertaking of contract 2, the client only at the moment gets 450,000. The house still with the bank. So step 3 needs to be undertaken then, so that the bank can resell the house to the client at profit margin. For contract number 3, the bank will give a seller the house plus the profit margin. So what happened after the completion of contract number 3? The client gets the house, the bank gets the profit, because the ultimate objective of the bank involving in 2 and 3 is to ultimately ended up with profit margin. The bank now expect the client to pay every month the installment for the loan basically. So that's what happened. What are the controversies in this contract? Few things just to highlight. Number 1, if you notice, contract number 2 happens when the client is not having a complete ownership of the house yet, because the client only pay the down payment. It's not complete ownership. But how then the client can sell the house to the bank? That's one issue, at least based on this model. Another issue is sometimes the profit margin charged by the bank here for contract 3, usually it is equal to the current interest rate. If the interest rate is 6% per annum, then the profit margin will be around that value. And that's why some scholars, being cynical to this contract, they call this as a backdoor riba. The practice like this, to some critics of such contracts, they call it, this is a form of a backdoor riba, which personally I would say that's a very harsh criticism, because the word riba itself is harsh. Riba is haram. But where's the haram things here? 2 is murabahah, 3 is bitaman ajil. Maybe the interest rate and the profit rate similar, but that doesn't make the profit and interest rate to be the same thing. That's another defense to this contract. So I personally would say, those who say this is a form of backdoor riba, that's too harsh and not really true. If we combine 2 and 3 together, this is what is known as bay' al-inah. If you have learned bay' al-inah, it's a controversial contract according to certain mazhab, because if you notice, contract 2, the ultimate objective of doing number 2 is not that the bank is serious to buy the house, and the client actually does not really want to sell the house, but 2 needs to be undertaken so that contract number 3 can be done. So some scholars would not approve bay' al-inah because the underlying objective of the transaction is hidden. There's a hidden agenda. Some Islamic scholars would say this legal stratagem or hiyal is not valid. This is a form of hilah, and if you read articles, they would say many scholars in the Middle East, because of their view on this, they don't approve that. So that's another controversies of this contract. In this model, we are looking at the equity financing contracts. Under the equity financing contract, we have musyarakah and mudarabah. First, let's focus on musyarakah contracts. The purpose of having a musyarakah is because there is someone, let's say partner, potential partner, who wants to start a business, but the person has no capital. Therefore, the person wants to find any partners to combine capital or to combine expertise so that they can start running the business. Consider then, another potential partner can be presented by the Islamic financial institutions. So this partner will then write a proposal to the Islamic bank, presenting his idea, pitching his idea, convincing for the other partner to invest in the project. Under musyarakah, the investment can be in terms of financial investment or human capital investment. By human capital, we are talking about expertise. All partners can do both things. They can share capital, they can also simultaneously sharing their expertise. Let's say both agree on this, and then they want to form that joint venture. This is the company actually. SME, small medium enterprise for example, should be here. The joint venture. This is the company. When the joint venture is formed, there will be a lot of conditions in the contract, a lot of clauses in the contracts. And one of the things we want to emphasize here is the profit and loss sharing contract, P&L, profit and loss sharing. It depends on the agreement, how much they want to share, the ratio. Maybe 10, 90, 30, 70, 40, 60 or whatever. After that agreement, once the joint venture is formed and run, let's say after some financial years, the business is making some profit. And this profit then will be shared between the partner according to the pre-agreed or predetermined profit and loss sharing ratio. If they are making 1 million profits, and if the P&L ratio is 30-70, let's say this one get 30, the other one gets 70, so 300,000 goes to this partner and 700,000 to the other one. So that's in the case of profits. The second possibility is when there's loss incurred by the business. Let's say in another financial year, the business incurs loss. Again, the loss will be borne by each partner according to the profit and loss sharing ratio. That's another situation. Just to give you a good imagination on how, when there is loss, the profit loss sharing ratio works. Let's say, because of the loss, now the business need to be shut down, close. Imagine first, when each partner want to form this joint venture, let's say partner A injected 1 million ringgit and partner B also agrees to inject 1 million ringgit. Together they have 2 million ringgit at the initial starting of this joint venture. After a while, they incur loss, they have to shut down the business. So before they dissolve the business, they sell the assets with the cash, they pay all the liabilities, and then they see how much money left. Let's say after all those, from 2 million capital injected, they ended up only with 1 million ringgit left. So that 1 million ringgit will be divided according to the agreed profit and loss sharing. So that's the idea when there is a case of loss. I hope that's clear now. What's the difference with mudarabah? In the context of mudarabah, we have the entrepreneur, or sometimes referred as the mudarib, and then the capital provider, or also known as the rabul mal. Usually the capital provider is the Islamic financial institution, and the mudarib or entrepreneur is the person that has the intention to start a business. He first would approach Islamic financial institution with his proposal, pitch his idea to convince the bank to finance the project. So then they will form a joint venture, and in that agreement there will be again the profit loss sharing ratio and with other clauses related to the joint venture. So when there is a profit from the business, then they will redistribute the profits according to the agreed ratio, predetermined ratio. But if there is a loss incurred, the rabul mal will lose his capital, depends on how bad is the loss. The rabul mal's capital will be affected, shrink in terms of his capital investment. And for the mudarib, he would also incur loss in terms of the efforts that he has put into running the business. Both parties experience some form of loss here. Two things I want to highlight. The common problems I notice from students when they talk about mudarabah. Naive statement, which for me does not reflect business or economic students. Very common I find in students' answer when they address the issue of mudarabah is, number one, when there is a loss incurred by the joint venture, only Rabul Mal suffers the loss. That's wrong. That's a wrong statement. It's not only Rabul Mal. You can say only Rabul Mal suffers the loss of the capital, and the Mudarib on the other hand is also suffering from another type of loss, which is he lose in terms of the time, efforts that he put in the business. Both suffer. Just imagine this, because some people cannot imagine losing effort. Imagine if you fail this course. After you study, you attend the class, you do assignments, one whole semester effort, at the end, you get F. And you feel frustrated. You feel sad because effort. Some would even say, if I can pay to pass, now money is not the cost anymore, as long as you can pay for the effort. So be mindful on this. Another issue I notice when students address the issue of mudarabah is, in the case of mudarabah, the Rabul Mal will not interfere whatsoever in the running of the joint venture. Again, that's a very naive statement. If I inject 2 million into this joint venture, I will not just let the mudarib run it like that's his money. That's not how people do business. The Rabul Mal may not involve in a daily operation. However, as investor, the Rabul Mal will still involve in the operation of the business at another level, such as there will be meetings, there will be annual reports, semi-annual reports, gathering of the shareholders, where the mudarib or the CEO have to brief what's going on with the business, and then the Rabul Mal will give his feedback, will say something, will voice his concern, his opinion. That's very normal. That's a form of involvement. How Rabul Mal can have some say, can have some opinion in the way how the company is being run. Rabul Mal will not let the mudarib go loose and do whatever they like, their money. So don't make those naive statements about mudarabah. So those are the two major contracts, trade financing versus the equity financing. Don't forget to subscribe, like the video, and share with others. Thank you.